Now, what about the cash flows? For the contracts that stay open, there's going to be daily adjustments to account values reflecting any change in the futures price. So an important point to remember is daily settlement of gains and losses. That means every day when the market closes up, money will be added to the accounts of longs, not some random or approximate amount. The amount added to the accounts of the longs reflects exactly the increase in the value of the futures contracts. And where does that money come from? It's being taken out of the accounts of the shorts and passed through the clearinghouse to the accounts of the longs that have generated a gain that day. And of course, all that would run in reverse if the price went down. So there are daily adjustments in money. So this is not just an account entry, not just a note on some ledger somewhere. This is an actual movement of money out of the accounts of those who have lost money and into the accounts of those who have made money based on the change in the price. And again, it's based on the change in the futures contract price, not based on the change in the underlying value. Now, of course, because of arbitrage pricing, the futures price is moving in alignment with the value of the underlying, but it's not always precisely one-to-one down to the penny. So it's important to realize that these daily settlements do not reflect changes in the actual price of the underlying. They reflect the change in the price of a futures contract, and that's based on what is known as a mark to the market. And what is mark to the market? It simply means that you're adjusting account values in money to reflect exactly the change in the market price. And that's based on settlement prices. Money's not moving second by second as a futures contract ticks up or down. In general, money moves after the close of the session based on the futures contract settlement price. Now, as noted, a futures settlement price is analogous to a stock closing price, but they're distinctly different. A stock closing price is simply the price of the last trade reported before the closing bell or the close of the trading session. For futures markets, it's based on an average of futures prices over the closing range. Now, the curriculum just makes a nod in this direction, so I'm not going to go into it in great detail, but the closing range is a period of time that is established for different futures contracts. For some, it's the last 15 seconds. For others, it's the last 2 minutes of trading. And they take a volume-weighted average price, but I just gave you more detail than you have to know for the test. All you need to know for the test is that a settlement price is like a closing price, but unlike a closing price, which is simply the last trade price reported, you're taking an average of prices of trades that take place around the end of trading. And as noted with respect to that daily settlement, this does occur daily. Now, this is an overly simplified diagram, but it gets at the point that each day we're reflecting the change in the futures price between one day and the preceding day. But cumulatively over time, by the time you get the settlement, and of course, if I held a position for 30 days prior to the delivery date, there'd be money adjustments day by day by day. But cumulatively over time, those daily settlements would reflect the full change in the futures price from the day you initiated the position to the day you offset the position. And if you held a contract all the way to delivery, it would reflect the difference between the price at which you initiated your futures position, the small f, because note on the test, they'll use large F for forward prices, small f for futures prices. And so if I hold a position all the way to delivery, then the value, the total gain or loss over the time to delivery would be the difference between the futures price at which I initiated my position and the spot price of the underlying asset at the delivery of the futures contract or maturity of the futures contract.